Mr. Buffett, how can I make $30 billion?
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old. I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. I mean, you have to buy businesses or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about. And you can't expect anybody else to do it for you. I mean, people will not tell you about wonderful little investments. It's not the way the investment business is set up. When I first visited Geico in January of 1951, I went back to Columbia, and that rest of that year I subsequently went down to Blythe and Company, and actually to one other firm that was a leading, Geyer and Company, that was a leading analyst in insurance. And I thought I'd discovered this wonderful thing, and I'd see what these great investment houses that specialized in insurance stocks said, and they said I didn't know what I was talking about. It wasn't of any interest to them. You've got to follow your own. You've got to learn what you know and what you don't know, and within the arena of what you know, you have to pursue it very vigorously and act on it when you find it. And you can't look around for people to agree with you. You can't look around for people to even know what you're talking about. You have to think for yourself.
Such timeless tips. Now let's take them one after the other. The first one is start young. I'll give an example using a compounding calculator. If you start out today, say for example you are a 20-year-old and you have about 40 years to retirement, and you start out with just $1,000 invested at 10% for the next 40 years up until you're 60, and you just put in $100 every month, guess how much you would have at the end of your period? $686,000. Over that period, you would have earned $637,000 plus. However, if you wait till a later date, say till you're 50, and you start out with a bigger amount, which is $10,000, compared to the $1,000 you started with, when you were much younger, and say you were more aggressive, of course, you put in like $1,000 every month, still earning the same 10%, you would have as your future value $231,000. Now compare what you had here, $686,000 versus the $231,000, and you would really see the beauty of starting early. Starting early allows you to compound your money over a longer period and earn a bigger amount. Now, the second thing he said was to buy small companies. Okay, I'll take an example using two live companies. An online company known as Amazon, which everyone should know about, an online marketplace, and a smaller counterpart called Context Logic. Okay, now let's get into why small companies have a tremendous advantage over big companies sometimes. As it stands now, Amazon has a market capitalization of $1.84 trillion. The market capitalization of a company is the total number of shares that company has in issue multiplied by the share price. So with Amazon's 1.8 trillion, put side by side Context Logic's market capitalization of 6 billion. that tells you this is a big company while this is a small company. Now, what Buffett is saying is it's easier for this 6 billion to turn to 60 billion or even 600 billion than it is for this 1.8 trillion to turn to 18 trillion or 184 trillion. That's like the GDP of economies put together. So it's easier to make more money on well-selected small companies compared to bigger companies. However, a lot more goes into analysis than just picking small companies. Warren Buffett's third tip is to buy stocks at attractive prices, and would again take Amazon as our example. If you check the 5-year chart for Amazon, so this chart shows the prices of Amazon over time for the last 5 years. Now, assuming I bought Amazon at $765, okay, way back in 2016, I stand a better chance to earn more return than someone who buys Amazon at $3,645. Why? Because at this price, it's more attractive to get into Amazon compared to buying it at this price. Again, there are a lot of calculations that go in, but I want to keep this simple. His point being that when you analyze companies, even though they are great companies, it's always good to get them at deep discounted prices if possible. For example, if there's a recession and Amazon drops to say $2,000 or $1,500, that might be a good entry point because it's an attractive price. Warren Buffett made the fourth point about investing for yourself, and I would use this concept to explain management fee. Every time you give your funds to a fund manager to manage, in exchange for his services, he charges a management fee. Okay, now that management fee typically ranges between 0.1% and 2% of AUM, that's assets under management. That's your assets that they're managing. So whether they make money, whether they lose money, they take 2% of the value, or as low as 0.1%, depending on the asset manager. One way to avoid paying this fee is to learn about investing and how to pick stocks so that you can be your own money manager. And that's one thing I started to learn quite early in my career. And right now, I typically manage my funds myself. But again, it takes a lot of training and discipline to be able to manage your own funds. Warren Buffett spoke about following your convictions, and I'll use that to explain something called Analyst Recommendations. Okay, so from time to time, a group of professionals called analysts take a look at companies, they analyze all sorts of parameters, and they assign recommendations to those companies. Strong sell, sell, hold, buy, strong buy. Now, there are instances when those analysts could go very wrong. For example, there was a time that a stock called Tesla, an electric vehicle manufacturer and energy producer, was seen as a strong sell. However, as time passed, the company eventually became a strong buy because they proved most people wrong by delivering on targets and breaking grounds that no one thought was possible. In another way, some companies could be tagged strong buys, and at the end of the day, they end up being strong sells. What is Buffett saying? He's trying to say that you should do your own due diligence and have your own convictions when you invest in companies so that you are not swayed by some of these recommendations. Because indeed, sometimes behind the scene, some analysts might have some vested interest in giving analysis to suit their own firms at your expense. Finally, Warren Buffett spoke about acting promptly once you've made an investment decision and you see the opportunity. Now I'll give you a practical example. I had analyzed Facebook sometime in 2020 for purchase. At that time, Facebook was trading in the low 200 range. However, I delayed in buying Facebook at that time, and look where Facebook is right now, $373. I made that mistake because I did not act fast. I kept postponing the decision, and I just might have lost that opportunity on Facebook. So the key takeaway is to act fast. Haven't done all this, haven't done your research and analysis, and seen the companies you like. So that's about all I have for you in this video. Do leave a like and subscribe and come back for more content like this. Cheers.